So the most impressive thing I saw out of that announcement was that the AirPods can be used as hearing aids. And if that's the most impressive thing Apple's announcing, I think it was extremely underwhelming.
Welcome to the Telltales podcast, where we discuss cash flow and its pivotal role in investing. I'm Mike Nicoletti.
And I'm Jason Wallace.
And don't forget to join our email list at telltales.us to get the cash flow memo. It's about 20 pages covering 80 companies, U.S. government's finances, and the energy sector.
It's like having a masterclass on investing in your inbox every week.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Hi, Hunt. Can you hear us?
Hear you loud and clear.
All right.
Jason there?
I'm here.
Hey, Jason.
Hey.
Minimal amount of time on the back three exhibits. Oil is a decline. Covered last week. If you look at the China forecast for 25, it now looks like China's going to be flat. Now, that's only 400,000 barrels out of 100 million barrels, but it does have an impact. And the main problem is that surplus capacity at the bottom of it, which is still 4 million barrels. Most of that is in the hands of the Saudis and Abu Dhabi. So I don't know. As I've said before, and I'm going to quickly cover some of the energy companies today. If you want to own a really good upstream oil company, I just wait or I buy a half position. But I definitely wouldn't leave a position I was in. Natural gas, Exhibit B, is just totally unprecedented. The problem here, of course, is dry gas production just keeps going up. And the fact that it's 102 and 24 is because two large producers in the Marcellus, EQT and Chesapeake, have 1 million a day each pulled off the market. It would be 104 if they weren't curtailing. LNG, which was supposed to be the future market, as you can see, is flat year over year. It will go up next year, but this year is very disappointing. Projects delayed. The futures curve last Thursday, 215 for October contract. That is very low for this time of the year. It's better in 25 and 26, but we have to keep an eye on that production number. And the place to keep an eye on, if you go to the top, is the Permian. The Permian's 18 Bs a day. The next time this gets revised, that'll be 19. The largest area, Marcellus, is flat at 35. Haynesville is down. What I don't understand is why all other isn't declining, but maybe we'll see that with the low prices. Exhibit A, which is a cash flow statement for the U.S. government, as predicted, the two presidential candidates debating last night did not get into curtailing spending. Whoever gets elected on November 5th is going to have to deal with it. You've seen in the papers larger numbers for 24 than $1.6 trillion deficit. CBO just came out with new numbers. I'll try to track those numbers down. They're saying $1.9 trillion or something. I think some of that is student loan forgiveness, but I'll check that. In any event, it's just too much, and there just has to be some curtailment. Since oil's not behaving very well and gas is not behaving very well, what the next thing we do in the next 5 minutes is just go through the energy pages. Once again, we're going to get to the front of the memo pretty quickly, but on page 12, which is the gas box, has been upgraded to 6 months. These companies, if you're in them, stay in them. If you want to start a position, the three here, Antero, EQT, and Chesapeake, are all pretty good. Antero's my favorite because we helped start it, and we still own quite a lot of it. There's an interesting comparison on this page. Antero Midstream is here for a reason. Antero Midstream is the midstream sub of Antero, and Antero owns 30% of it. And it's managed by pretty much the same CEO, Paul Rady, and managed out of the same office. It's fundamentally different in that it doesn't have the commodity risk. So if you go down to enterprise times free cash flow, Antero's 10 times based on a little better gas prices than current, and Antero Midstream's 20 times. You can see Antero Midstream has more debt, but it's more predictable cash flow because it's gathering gas, it's processing gas, doesn't have the same exposure to commodities. And is Antero Midstream a better holding than Antero Resources? It's different. It's less volatile. If you owned Antero Resources, would it make sense to buy some Antero Midstream? Probably. I mean, it's the same management team. Does it give Antero Resources an advantage having a sister company doing its processing and gathering? Absolutely. Absolutely. It's much more efficient. With that as an introduction, I'd like to swing into, rather than do the EOG page, I'd like to do the Kinder page, which is page 10. These are midstream companies. And you can see that they're trading at a fairly significant premium over the gas companies, just like Antero Midstream was trading at premium. Kinder's 19 times. This is times free cash flow. This is after CapEx. Enterprise is 17 times. Energy Transfer is 13 times. Western 16 times. They have a lot of debt. It's very much like Antero Midstream. Are these good businesses? I find fault with the amount of debt. If I were buying Antero, I would have $3 in Antero Resources and $1 in Antero Midstream. I just don't think debt, even if you have predictable cash flow, is such a good idea. But these are good companies. If you're looking for something to buy, gas companies are gas companies. If you want a more diversified company, and you turn to page 11, the best large diversified company, in my view, is EOG. Why EOG? Well, it's multi-basin. It always keeps its CapEx at only about half of their operating cash flow. So you can see here, I'll revise this weekend, but their CapEx on a run rate base around $6 billion, their free cash flow is around $6 billion. So they're spending half of the cash flow. The key is, can you do that and have unit production growth? And for the last period of time, through the 3 months, it'll probably be somewhat less when I get to 6 months, they're having 8% production growth, which is really remarkable. To spend half your cash flow and have 8% production growth is just quite an achievement. EOG is very large. Magnolia, the second company on this list, is much less large. EOG has almost 500,000 barrels a day. Magnolia has 33,000. But you see the same characteristic. See the CapEx, 400 million, free cash flow, 500 million, and also 8% production growth. I mean, that's remarkable. Now, Magnolia is doing it all in one area in East and South Texas in the Austin Chalk. No one 5-10 years ago would have predicted that particular formation would support something like Magnolia, but they definitely are making their way in the world. The other two companies on this page, Diamondback is especially impressive, what they've been able to build, but the thing with Diamondback is they've done a lot with acquisitions, so it's much less hard to figure out what they're really doing on an organic basis. Same thing with Permian. Permian it's all Delaware Basin, and they're very active on the M&A front, so it's harder to kind of chart how they'd be doing if you didn't have to always pro forma in the acquisitions. So the only other energy page here, so we can get to the front of the memo, is Exxon, Chevron, Conoco, Oxy, and Cheniere. We've talked about these in the past. They're only updated through the 3 months, and I don't even have the files with me this weekend up to them to 6 months. I'll get to that next time. They're generally in the 11, 12, 13 times free cash flow. I think they're good investments. I don't think you'll get the same kind of an uplift that you will from the kind of performance that EOG and Magnolia show, or for that matter, the gas companies, especially if gas starts to recover. But they're not bad investments. Last week, because I've used too much of our 30 minutes already, last week I came up with an hypothesis. If you go to page 1, and that is that in a 3.7% 10-year Treasury. I'm sure if the Fed funds rate comes down, even though, the U.S. government has an awful lot of financing to do, I suspect that a 10-year bond, which is kind of the base rate in our economy and in the world, is going to stay in that, 330, 340, 350 range, which the inverse of that is 30 times free cash flow. So I hypothesize that a value investor with a company that had very strong position and could grow its free cash flow, that 30 times free cash flow was, if you're interested, let's just pick Alphabet, for example. If you're interested in establishing a position in Alphabet and it got down in the range of 30 times free cash flow, you could at least start the position, even though you had concerns. I think Mike and Jason pushed back on that a little bit because they're trying to find businesses of this quality cheaper, with these companies are all in the Magnificent Seven, with them adjusting down. I was looking for some way to say, when you could start to look at them and be comfortable. They might go down further, but be comfortable by making investment now and making it for the next half decade or decade. I don't want to rehash what we talked about last week, but over the intervening week, Jason or Mike, any more commentary on that way of looking at these very large, very successful companies?
The main thing that I add to that I kind of wish I had gotten into last week was that the higher that number is, the more confident you need to be in future growth. And I do think in a way the current multiples are indicative of what their potentials are. It's impossible to predict the future, and it's part of as a quote unquote value investor, you want to buy something for less than it's worth. And there's many ways to do that. You can try to predict what the future is going to hold, which is hard, but not it's an exercise. If Alphabet's the cheapest one on here, they certainly have some avenues for exceptional growth. There's maybe some potential challenges as well, but they certainly have the resources. You also got to remember that these companies employ a ton of people, probably more than they need to. We were just looking at employee headcounts at Microsoft. It's 220,000 people. They actually employ more than every other company on the sheet. With the improvements that they're getting out of AI and what we're seeing in a number of different businesses, we will likely see a lot more operating leverage, not just in these businesses, but in businesses in general going forward. We probably expect to see more operating leverage. So, just as a long-term big picture, you could likely make a case for additional free cash flow growth, even if revenue growth is tepid.
Yeah, I would add two things.
Oh, go ahead, Jason. But then I have a question for Jason. But go ahead. I'm really interested in this employee headcount thing. But go ahead, Jason.
Yeah, along those lines, the stat I've been hearing is a 10% improvement in productivity for large companies that adopt AI. And presumably these 5 companies would have a larger, potentially larger boost to productivity since they're early adopters of AI and much more mature around using that technology. So maybe not layoffs. They had layoffs a year ago, I think, all the big tech companies. So maybe through attrition, they lower their head count and then at the same time increase productivity. The other thing is Mike and I have been doing a little thought experiment occasionally with around the Mag 7 of choosing the one, looking out 10 years, which one potentially won't be around. So it's a fun experiment. I don't know if Mike, if we want to get into our latest pick. Our pick changed this week. It was Alphabet, and now in my mind, it's Apple. But maybe that's another.
We could spend a lot of time on that.
Jason, that's what I was going to ask about. How underwhelmed you were by the Apple
Oh yeah.
product day or whatever they call it.
So the most impressive thing I saw out of that announcement was that the AirPods can be used as hearing aids. And if that's the most impressive thing Apple's announcing, I think it was extremely underwhelming. And a lot of the analyst commentaries said similar things, that maybe the AI, the iPhone upgrade super cycle doesn't happen because the product wasn't compelling enough. I would definitely agree with that. It wasn't even clear to me that Siri was using the generative AI features. So it was marginally better. It doesn't just interrupt you if you change your train of thought, but by no means was it impressive. And I thought they were really gonna show a version of Siri that was extremely impressive. One thing with the Apple Intelligence that was along the lines of what I was expecting is you could take a picture of, say, like an event flyer that's announcing, some event that happens next week. It'll read the text in the picture if you point the camera at it, and then add that to your calendar. So that's the kind of thing I was expecting, but I was expecting them to have that Apple Intelligence integrated across all of their, in-house Apple apps. And all they showed was an integration of reading text from the camera and then putting it on the calendar. So, I think I don't even know if it's half baked, the Apple Intelligence yet. It's very early. It kind of solidified in my mind that I want a new iPhone mini if I can get my hands on one rather than one of the iPhone 16s, just because I like the smaller form factor. And then the other interesting thing about it was that they are not raising the price of the phone, and they haven't for a number of years. This new phone has more memory, which memory is maybe the most expensive component in the phone. It's using the 3 nanometer TSMC chips, which they've raised the price on those as well. More battery capacity, newer materials. So with all those changes, they're not raising the price of the phone on top of the inflation we've had. So I fully expect the margin on the phone to come down. And they had good hardware margins, but it's not software margins. So, Mike keeps bringing up the point is clearly they're going to be a software company in the future. And I don't think it's there yet, but maybe it's projected in the next couple quarters. They'll derive more profit from software and app store sales than hardware sales.
And you'd expect probably flat results in that case, as you gave up hardware margin and to be replaced by software margin.
Right. They're giving up hardware margin, and maybe they won't sell as many iPhones as people initially thought. So yeah, I wouldn't look for a big jump in earnings.
Can I provide the alternative view?
Absolutely.
It was a boring presentation. So I guess I agree with you there. But I think Apple's becoming a boring company. And that's probably what it's supposed to do. We think of Apple as this company that's created some very revolutionary devices. But at this stage in the company's life cycle, they're becoming more of a services business. So the lifetime value of a customer is stretched out over many years. You buy lots of devices, and their goal is to keep you in the system. So that makes sense from the perspective of not raising the price on the phone. It also recognizes that they want to give their customers less incentive to go out and try the new Google Pixel phone, which clearly has some really cool and neat features. So at this point, they need to keep people in the system more than they need to draw people into it. They need to just retain what they have. So this all doesn't sound like a great case for Apple, but as services revenue takes on more of the pie, it will be a more profitable business. Now, caveat with the fact that maybe they won't be able to receive $20 billion a year from Apple Google. So, they could have bumps in the road, but I think it's probably okay and expected that they're going to be more boring going forward.
Yeah. So why I put Apple as my pick for the Mag 7 that won't be around in 10 years, or in the same dominant position that they're in, is if they are shifting to a software company, and if they're going to keep people locked into their ecosystem through additional software products. They haven't demonstrated that they are a excellent software business. They definitely are on the hardware side, but not so much on the software side. So the App Store is revolutionary, but it's really just collecting a toll on innovation that other people are building through their apps and then selling on the Apple App Store. So last night, Mike and I were at an event where Mark Zuckerberg was speaking, and he was just making the point of how focused they are on creating the best software possible. And if Apple's moving into being a software business, and they're going to compete now with Meta and Google and the other software companies, and they're not great at software where those businesses are, they're at a real disadvantage, I think, long term.
Yeah, I mean, he said that pretty explicitly, that he felt that their biggest competitor over the next 10 years would be Apple. And that's telling. And that's driven from that comes from the fact that their challenge has been getting approvals on the App Store, and Apple's been a constant threat or impediment to their growth and their being able to do what they want to do. So definitely Zuckerberg has a clear vision that they want to own the next platform. And, he's your prototypical computer science nerdy guy, right? Like, he loves open source software. Like, he thinks that if he has the opportunity to build this net platform, whether it's glasses or whatever the form factor takes shape, he will be able to set it in a way that will be his vision for what the future will be.
Yeah. And he's a founder CEO. So he's going to accomplish his goal, whatever he sees that to be. He's going to do everything in his power to accomplish that goal, where, Tim Cook's the steward of Apple now. So will he have the same passion for it?
Hi, I'm Dawn at Oak Cliff again. It was just 2 weeks ago that we had international sailors converging on Oyster Bay for the Triple Crown, the final Triple Crown of the summer. We sent a team racing around the vineyard. We sent another team racing around Connecticut Island up in Newport, and we set the record for the course and won first in class and third overall. But now everything's coming home. We're in Oyster Bay. High school sailing starts tomorrow. And then we'd like to announce and invite all of you to the Harvest Regatta, which will be on Saturday, September 21st, starting at 10 a.m. So get on the trains, get your schedule sorted, maybe even come up with a costume. And that's the regatta where we go out. It's fun. We're done by 3 or 4, and you go out and you pick up pumpkins bigger than this that all have a prize attached to it. So it's just a fun, come out, enjoy, bring your friends, sign up online at oakcliffsailing.org, and we hope to see you here this fall.
We don't have time this week because we have to see if we have any healthcare catch-ups. We're running out of time. But next week, let's go through the case of Google not being around 10 years from now. but we'll hold that for next week. Jason, anything on Lantheus or Vertex or BioNTech or Harrow or
Yeah. I'll try to make the highlights quick. So there was a couple big healthcare conferences this past week. Vertex was at the I believe it was the Morgan Stanley conference. And Reshma Kewalramani was kind of updating their whole pipeline in the presentation. And she mentioned that she's looking forward to next year, 2025. And it's something that Mike and I have been talking about for quite a while, is they see that they'll have potentially 3 franchise drug programs next year rather than the one they have now. And that's a huge step for them. Also, she used some interesting words when discussing their type 1 diabetes stem cell treatment. I don't believe I've heard her refer to it before as a cure for type 1 diabetes, but she did this time. So that was something I was hoping for and excited to hear. Since personally I've been hoping for a cure for quite a long time. And, it tells me that their data shows that type 1 diabetes treatment is very durable, and it's not just a temporary restoration of pancreatic function, and that, it could potentially be a lifelong cure, as she's saying. Harrow also gave a presentation, and it was really good. So if you're interested in the company, I would try to look up the transcript or see if you can get a video of it. Again, these are like financial conferences, high level. So Mark Baum, the CEO there, he was going over all of their, kind of franchise drugs. But the interesting thing in that one was he discussed specifically Melt Pharmaceuticals. So that, if you remember, one of the things that we really liked about this company is they're willing to spin out their research into standalone companies. And let them fund the early stage research themselves rather than Harrow using their own cash flow to do that. So in Melt's case, they are entering a phase 3 study for their single asset, which is a wafer that you place on your tongue, and it delivers an anesthetic to use pre-surgery. So specifically on eye procedures, but they're also seeing demand from dentists. And it's a lot easier than placing the patient on an IV for maybe a relatively quick outpatient procedure. So Harrow makes that anesthetic today from their compounding pharmacy. And since it's not an approved drug, it was just spreading by word of mouth for demand. So he said that they make about 150,000 doses annually out of their compounding pharmacy. And what it ultimately means for Melt is if they... And they're going to have their phase 3 data by the end of the year. So if at some point next year they receive approval, they might have a $100 million business built in at launch, which would be great. And Harrow owns 46% of that business with a 5% royalty. So not insignificant at their size. And then I guess BioNTech's, they're going to announce a lot of data next week at a big oncology conference. So we should have an update on them next week.
How close are they to having revenue from that product, do you think, Jason? It's still years, right?
In Harrow's case?
In BioNTech's case.
Oh, in BioNTech's case? Well, they're going to update 3 different programs. So yeah, it's years. But some are closer than others.
Yeah, this is on page 15. They're doing a remarkable job of hanging on to their cash.
Right.
As compared to Moderna.
Right. They kind of optimized for efficiency in their development pipeline, where I don't believe Moderna did to the same extent.
Right. Anything else, Mike, before we call it a day?
Yeah, I mean, I think that's a good distinction, and since we'll talk about it more next week, at least understanding that Moderna and BioNTech took 2 different paths to commercializing their COVID vaccines. Moderna did it on their own, and BioNTech partnered with Pfizer. And you can see where the companies are today, in that the decision to outsource the distribution to somebody else who is very good at that turned out to be a better decision. Now, we don't know what the research programs will come out. It could flip the other way because the value of clinical assets are very different. But the way things stand today, BioNTech is a much more sustainable business than Moderna, as we sort of predicted.
Great. Well, we got a couple of projects to raise next week. and I will take less time. I think the energy run through this week will do it for a couple of weeks. In the meantime, everyone be well and stay healthy, and we'll be on the phone with you in exactly 7 days' time. Take care, everyone.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.